All right, should we make a start? First of all, thanks everyone for coming and spreading yourselves out so it looks full room. I appreciate it. So this is one of our investor insight evenings that we hold quarterly. So tonight's topic we're talking about volatility or coping with volatility, and we'll get into a little bit more about that soon. But first, just to get the technical stuff out of the way, anything we talk about tonight is just a general nature, so it's not specific financial advice for your situation. By all means, have a chat to your advisor afterwards if anything you think might relate specifically to you. So to begin with, what is volatility? Now, volatility, put simply, is fluctuations in prices. So that can be share prices, property, any asset, commodity prices, but volatility is when you see prices going up and down. So it's not necessarily always on the downside, it can be volatility on the upside. And now what I've got here, is probably a little bit hard to see at the back, but this is an index of volatility. So what this measures is changes in share prices over time. And this is for the American market. But really, you don't necessarily need to see the numbers here, but what you can see is during large periods like this is when volatility is extreme. And probably no surprises there, that's in the 08-09 period, which was during the global financial crisis when asset prices were moving up and down wildly. And then over time we have periods of volatility, it's never goes away, and then relative periods of calm over 12, 13, 14, until we find ourselves around about here. And we've all known in the past 12 months, particularly in the share market, we've seen it come off 20%. So it's been quite a volatile period of late in the share market, not only in Australia, but in most share markets around the world. We're going to explore 5 economic themes that, I mean, there's always hundreds of things on the go in the market at any one point in time. But 5 key things just going to explore here that can explain some of the volatility we've really been seeing in the last year or so. First one is the end of the mining boom. So Australia had a super cycle mining boom over the years 2000 leading up to 2012. We all remember the period. Mining boom was pretty much the headlines every day in the paper. And we had the periods of the two-stage economy where we had the western part of the country really propping up the east with the WA, South Australia with the mining boom, house prices up, mining up, everything was booming, and the western, so the eastern side was lagging. Over the period, as you can see here, pretty much prices quadrupled. So this is a representation of all commodity prices. It might be iron ore, coal, a mixture of all of them. Then in 2012, we had a peak in mining investment. So this was a period where big mining companies like BHP, Rio, Fortescue Metals, investing millions or if not billions of dollars in new mines, new technology, new equipment to really ramp up their ability to extract commodities from the ground. Then what we see at the end of the investment boom is we've reached peak production. So the economic factors of supply and demand kick in. When there's more supply and there's less demand, prices fall. So what we saw over the last few years is commodity prices coming off substantially, and as I said, that's a representation of all commodity prices, but we've seen it particularly with iron ore because that affects BHP, one of our largest companies. Really, once the mining companies have finished their investment phase, then there's less jobs on offer because they don't need those jobs to create more mines, create more infrastructure. At the same time, we have more supply coming on the market because they're producing more, they're extracting more from the ground. And then the third factor came into play with the Chinese slowdown, which we'll have a look at in a sec. So those 3 factors really cause a sell-off, or volatility as it is, in commodity prices. Second theme I want to talk about is the oil price slump, and that's another common theme we hear a lot about in the news at the moment. You can see here in the graph again, oil around about $100, $130 a barrel, really came down and is currently around about the $50, $60 a barrel mark and has been lower. Oil, like most things in the economic world, is dictated by supply and demand. The more there is, if demand keeps up with supply, then you expect prices to remain stable. If supply and demand get out of kilter, that's when we get volatility. So what we're seeing at the moment is a few factors at play. The US, which traditionally would import oil from the Gulf, from OPEC, Saudi Arabia and the like, with changes in technology or advancements in technology, the US can now extract their own oil and they now become a net exporter of oil. So what that means is they're producing more oil than they actually need as a country. So they're now able to ship it offshores to other countries to buy from them. Now, understandably, the Saudis or OPEC, the cartels if you will, they don't like to see the Americas producing their own oil. They want America to buy oil from them. So ordinarily you would expect, because the US has created more oil, well then somebody will have to reduce their oil production to maintain the status quo. OPEC pretty much blatantly refused to change the oil production. They're keeping oil pumping out at the same rate, so the market's becoming oversupplied with oil. And what we've seen recently is, as I said, oil prices have come down dramatically. Other countries like Iran have had sanctions lifted, so now they can export oil. There's a lot more oil sloshing around the world, and as a result the price comes off dramatically and we see huge volatility in oil prices. Over time, market forces will prevail. What we'll see is that as oil price is low, a lot of the newer producers, in particular in the US, won't be able to keep up production because the price is too low. They need price at, for example, $60 a barrel to turn a profit. With the OPEC flooding the market, the price stays around 50. They'll eventually go out of business. They'll stop investing in new wells, new exploration techniques, and then we'll see the supply get soaked up over time and we should see a return to normality. Another key economic theme causing volatility in markets of late is the Chinese slowdown. And this has been one that's been reported for quite some time. This graph here shows, it's also got India on there just for comparison, but you can see in the red line, China GDP growth. So this is the rate that their economy is growing each year. And for many, many years, particularly during our mining boom, it was 10% plus. Huge amounts of growth year on year. And you almost come to expect that growth. But like anything, that's not sustainable. As I put down here, an established economy like Australia, America, a Western economy, typically will grow at around 3% per annum. So to maintain 10% year on year is just not possible. It just becomes too big. What we've seen in recent times is the Chinese government actually flag that with the world and say, look, we are not going to be targeting 10%. It's not practical. We're going to be aiming more for 7.5%. And there's a lot of toing and froing as to whether or not the data you can believe comes out of China, whether or not the data coming out of China is authentic or not, but pretty much at the moment they're around 7.5%. There's a lot of news as to whether or not China will go through a hard landing or a soft landing, and that causes a lot of volatility in the markets because the market doesn't know what's going to happen. We see prices fluctuate accordingly. In short, a hard landing pretty much means that we'll see Chinese growth really tail off, the red line tail off, followed potentially by a recession, which means that the economy won't be growing at all, and that would have huge ramifications around the world, particularly in Australia because we rely on China so much for a lot of our growth. A soft landing, so to speak, is more where the Chinese government will manage the slowdown. There's no doubt the economy is slowing down, it has to slow down, you can't perform at 10% a year, but can they do it in an orderly and sustained manner and get more of a soft landing? Again, these factors at play cause fear and volatility within the market. The fourth factor that has really got a lot of ground at late is the US interest rates. You can see I've got a graph here. This shows the US interest rate, which is equivalent to our RBA cash rate over time going back to the early 90s, and you can see it was around about 8%, and it's fluctuated over time. Well, what we've seen recently is pretty much since the global financial crisis in 2009, interest rates have been almost 0%. Now, that alone has caused volatility and a huge inflow of money into other markets around the world. The US is seen as a safe haven. It's rock solid. Investing money in the US government, similar to investing in the Australian government. You know the government's not going to go bankrupt. But when all you're getting is 0.25% or perhaps 0% on your money by investing in a US bond or term deposit, whatever the case may be, as an investor who needs income to support their lifestyle, you've really got to look at other options. And what we've seen over this period is investors starting to look elsewhere for higher returns. And in particular, the share market is often at play. So we see a larger inflows into the share market. That increases prices because there's more demand on the stocks, and we see the volatility go up along with the share prices. But you can see that little uptick there. That was a few weeks ago where the Fed, for a while, they've been signalling their intention, and then they actually raised interest rates. Only a tick. You can see that little tick caused a lot of volatility in the market, because what it signalled is that the US Federal Reserve thinks that the US economy can stand on its own 2 feet. It's going strong, it's going well. So what does that mean for volatility investment markets around the world? Well, now investors can get a little bit more on their investments if they're invested in the US government bonds or whatever the case may be. It's only a little bit, but it's a sign, because the Fed have also indicated that rates will rise again over time if the economy continues to improve. So as an investor with a risk-return trade-off, yes, I realised I had to invest in the share market. I know that comes at a risk, but I need the increased return. Well, now I can get an increased return by going to US government bonds, which are virtually risk-free. We see money coming out of the share market into fixed securities, and we see volatility in the share market. And the fifth economic theme I want to explore around volatility is property. And this is one not unique to the Australian market, but gets a lot of airplay in Australia as opposed to other areas around the world. Now, this graph shows property prices in Australia, being the yellow line, versus US, going back to the 1980s, so about 25 years. And pretty much what it shows is that over a 25-year period, Australian houses have gone up 12.5 times in value, whereas in the US, a more sustainable 4 times growth. And you can see periods like the global financial crisis where the US property market tailed off, went through a downturn, and then has picked up a bit of late. Our market, yeah, we had a little downturn in the GFC, but then it roared on ahead, primarily because we had low unemployment coupled with low interest rates, and I mean, overseas investors often get a lot of media attention, although it's debatable how large a segment they are of the market. So this, I suppose, shows volatility on the other side. Volatility in property prices has been high, but it's more because they just kept rising and rising and rising. Volatility doesn't necessarily always have to be a negative. Oops, sorry, that's the wrong way. So 5 economic themes that, particularly over the last 12, 18 months, of course, a lot of volatility in world markets, and in particular our market. But one of the key questions we often field as advisors is this time different? Surely it's different in the last 18 months than what we've been seeing during the global financial crisis or at any other period. Short answer, it's not different. The graph here shows the Australian share market going back to around about the early 90s. Now you can see this is our share market, the one that gets reported on the news each night, where on the ABC they might say the market's up 1%, down 2%, whatever the case is. That's the peaks and troughs we see here. And it's no surprise you can see over the early part of the 2000s leading up to 2007, the mining boom or the super cycle really pushed our market up to around 7,000, just below 7,000 points, followed by the global financial crisis where we pretty much halved in value, recovered somewhat, and then here's our recent bout of volatility. So really you can see, even going back 25 years, and the share market's been going a lot longer than that, hundreds of years of data, periods of volatility are normal. We have to cope with it. There are strategies that we can put in place to sometimes take advantage of it. But unfortunately, or fortunately, depending on which way you look at it, it's a part of everyday investing. We can't escape volatility. The table here, there's a lot of data here, but I'll just point you to a few key terms. What this shows is bear markets going back to 1987. Now, a bear market is characterised as the market falling 20% over a period of time. So what we've seen over the last 12 months is the Australian market was almost topping out at 6,000 points. We then fell to around 4,800, which technically was 20%. Are we in a bear market? And often bear markets, bull markets, they're very hard to identify without the benefit of hindsight. Often it's only when you're looking back at the data back in time you can see, oh, that was a bear market, that was a bull market. When you're living through it, it's very hard to pick. But what we can see here, for example, in September 1987, which was the stock market crash of 87, the market fell 50% over a 2-month period. Huge amounts of volatility. Investments in shares halving over 8 weeks. The market took 75 months, or nearly 6 years, or just over 6 years, to get back to where it was. So what that means is if you had to be invested in shares just before the 87 stock market crash, put the certificate in the drawer and not looked at it, in 6 years' time it will be back where it started. So you can see it can take time for markets to recover through volatility and get back to where they were. But what's important to also point out is that markets bounce. And what I mean by that is first 12 months after the low, you often see huge gains. So for example, during the 2 months when the market fell, yes, it took 75 months to get back to its peak, but 12 months later, it had already regained 35%. Now, if you're a panic investor, you sell out, you miss out on all of that gain. And that's some of the strategies we've got to cope with volatility. On average, as we can see here, going back even to the 1900s, the market falls around 33% in a bear market. It can take about 3 years to recover back to its peak, but also increases 30% of that recovery in 12 months. So, keeping with the theme of 5 points, 5 strategies to combat volatility, which we'll walk through now. Don't panic being number 1. And what I meant by that was, as I said earlier, just because that we're experiencing periods of volatility doesn't necessarily mean you should sell everything and sit on the sidelines. And what this graph shows here is if you had been fully invested this is the American market, although it does apply to the Australian market. If you had kept your money invested in the share market over a period of 20 years, the American market, you would have made on $10,000 investment, $58,000, 9.22% return. So that's if you had invested on day one, 20 years later, you've made a 9.22% per annum return. Yes, you've had periods of up, periods of down, but on the whole, it's overwhelmingly positive. If, however, you panic, you pull your money out after periods of increased volatility, and because you never know, when the danger of pulling out is you never know when to get back in, and remembering that the market does bounce quickly over a 12-month period, as we've seen in the previous table, you missed out on the 10 best trading days because you were sitting on the sidelines waiting to get back into the market to see if there was a sustained period of increase in prices. Pretty much your return is halved. So it's really those 10 best days that give you half of your investment return over a 20-year period. It really goes to show that don't panic, it will get better over time. Sitting on the sidelines, pulling your money out in cash is not really a successful investment strategy. And then you can see as the more best days you miss, your return gets worse and worse over time. Second strategy is similar to the first, keeping a long-term perspective. Now this is an interesting graph here that shows the percentage of days the share market is up versus down. So this is the percentage of days we get reported on the news, market's up today or market's down. And what we see, the blue bar is the Australian market, the red bar is the US, pretty similar. There's a 50% chance on any given day that the market will be up or down. It's a toss of the coin. Nobody can predict if the market's going to be up or down tomorrow. And often as advisors, we comment and say, well, we don't know what the market's going to do tomorrow, but if you're invested for the longer term, the positive return will prevail over time. And we can see that. When you're invested looking at over years, there's an 80% bias towards positive returns. And when you're investing over decades, it's pretty much 100% bias. So if you keep that long-term focus, the positive return prevails. Today, tomorrow, it really is anyone's guess. Nobody can predict what the market's going to do. Third strategy is dollar cost averaging. Now this one's a little bit more technical, and pretty much what this means is just because on January the 1st you've purchased $1,000 at $20 a share, market drops to 15, 10, 18. If you continue to buy over periods of time, it doesn't necessarily have to be a month, that could be over years, over months, but if you continue to buy during periods of volatility, you end up with an average price. So you're not necessarily buying everything at $20, just like you're not all getting at $18. What this table shows is that if you bought $4,000 over 4 parcels, you actually work out with an average price of around about $14.70. So this is a strategy to combat volatility, because if we're not sure if the market's going to go up, the market's going to go down on any given day, you can use dollar cost averaging to reduce your returns or increase your returns depending on which way you're doing it. Fourth strategy is diversify. Now, I certainly don't expect you to comprehend this graph, but it's deliberately there to show you. It's just, it looks like my 4-year-old painted it. But what this graph shows is different asset classes down the side here, Australian shares, international shares, cash and the like, from best performer, or sorry, worst performer up to best. So we can see, for example, in the year 2000, the worst performer is the blue, international bonds. The best performer that year was the yellow, international shares. And what this graph shows is nobody can pick what the best asset class is going to be in any given year. And that's why we diversify, that's why we spread your investments. And I'm sure many of you would know in your own super funds or investment portfolios, we recommend investing your assets across a range of different asset classes and sectors within those asset classes, because that allows us to diversify. While one sector's up, the other might be down, and that smooths your return and allows you to cope with volatility, rather than having everything in the share market, for example, and it's up and down with increased volatility. And the fifth strategy is the one that you've probably heard us use the term many times dealing with you individually, is rebalancing. And this is probably one of the most powerful ways to combat volatility. Now, put simply, rebalancing is taking money from one asset class and distributing it to another. So what we've got here, for example, an asset class of 50-50, let's say green is shares, blue is fixed interest. That's how we've set your super fund or investment portfolio up. Over time, as markets move, we might find that the share market increases or the share market decreases, and all of a sudden your asset allocation is out of whack. What do? Well, what we recommend, we'll come to you and say we recommend selling down some of the shares, moving that blue back to green, so to speak. So selling shares, buying fixed interest assets to reweight the portfolio back to its 50-50 asset allocation in this case. Now what we find how that combats volatility is because as markets are rising, we're locking in profits on the shares because the percentage of shares is growing within our portfolio. We're investing in fixed interest assets which will stay secure and are not expected to change in value. Over time, as markets fall and we find that we're now underweight shares, we take money out of fixed interest, put it back into the share market, always working back towards a 50-50 split as in this example. And we find that over time, as markets are rising, we're taking profits, and as markets are falling, we're buying back in. So in a way, we're combating volatility by taking advantage of the peaks and the troughs that can occur over time. Now, the last strategy, which is a bonus strategy, if you will, is really to drown out the noise. Today, in the information age, we're inundated with information. We've all got our smartphones where we can check any second of the day, what's the share market doing, what's my portfolio doing. We've got regular news feeds, what's happening in the US, what are they doing with interest rates, what's the oil price. As we saw a few charts ago, day to day it's anyone's guess. Drown out the noise, concentrate on the fundamentals, stick to your rebalancing and listen to your advisor, and that's probably the best way to combat volatility. Thank you. Any questions?
You had a graph with India and China. Now, China we know is gone up and down. Is India going to do the same sort of thing? Is India a developing economy?
It is a developing economy. India is a more of a westernised economy as opposed to China, which communist, dictatorial. I'm just trying to find it before you. So China has the advantage where it can move quickly. If they want to build a new road, well, too bad, they build a road through your house, you've got to move. India's a more of a democratic environment, similar to what we live in here, things take time. So India is viewed as one of the emerging economies that we'll see over time. Will it, I suppose, benefit Australia as much as China has? Probably not. They've got their own reserves, that they can generate their own steel as opposed to needing to import Australia's iron ore to build their nation. Coal's another example, yeah. So in India, there's an acronym in the investment world called BRIC, B-R-I-C or B-R-I-C-K, which is used to categorise emerging markets. Brazil, Russia, India, China, Korea, B-R-I-C-K, sometimes Korea. And they're broadly viewed as the emerging economies that will give a lot of growth to the world.
Because I mean, there's close to 800 million of them, which is about the size of Europe, really.
Yes, it's a huge country. Yeah. And so, it's a powerhouse. Whether or not it's a powerhouse that will directly correlate to more money in Australia's pocket remains to be seen.
Why do those seemingly micro movements in the US Fed Reserve's interest rates cause volatility? I think it went 0.25%.
They did, yeah.
It seemed like, read the paper, you think the world was going to end.
Yeah. One thing markets don't like is uncertainty. If the market knows what's going to happen, it will not react at all. But when the market doesn't know or it's unsure, that's when we see increased levels of volatility. More specifically with the Fed increasing interest rates, that's a signal that their interest rates are going to increase, or that they've actually come out and said interest rates will be increasing over time if the economy continues to improve. So what we see there is, as I said, a shifting of wealth, if you will, out of other asset markets, in particular the emerging economies. Over the period of sustained low interest rates, a lot of the emerging economies benefited that because investors looked offshore, higher returns in the emerging economies. That comes with increased risk. So particularly in these BRIC economies, we've seen huge outflows of money towards the US because you can start to get, it's only 0.25% now, might be 1% in 2 years' time, and so on, until rates normalise.
And if I may ask another question, you had the first one was, number one was the end of the mining boom.
Yep.
It seemed to me that the actual trigger of that was number three, the Chinese slowdown. Is that a correct assessment? Or
Yeah, it was a Chinese slowdown, but the Chinese slowdown just meant that they weren't consuming as much of our commodity, iron ore in this case, or coal. But prior to the lead up at the end of the mining boom, during the investment boom, we had BHP, Rio and similar companies really pouring billions of dollars into more efficiently extracting it from the ground. So they almost flooded the market themselves with iron ore. There was so much iron ore out there. At the same time, China slowed down and said, well, we don't really need it as much anymore. So those two factors really contributed to it. But China was a huge part.
If you believe the advertising, they say that, or the ads say that annuities are a way to hedge against volatility. Do they have a place in a balanced portfolio? Potentially.
I mean, annuities have almost become flavour of the month of late because we've seen such increased volatility, and they are a way to safeguard against that. Annuity, so to speak, is where you will invest your money within an annuity, and then you'll effectively contract to get a regular payment from that annuity over time, or similar to a pension that you're drawing from your super fund. But the annuity is set in stone, so it's you invest your money. You know with certainty you're going to get that payment every month, every year for the predetermined period of time. So we do see increased investment in annuities during these periods. from time to time, we look at the landscape of particularly annuities and look at them to say, do they have a place in our clients' portfolios? But I suppose the key negative against an annuity is the loss of access to capital. Because the annuities are all designed on formulas to say, well, if you invest $500,000, you're 60 years now, you're going to live for another 25 years, so we'll pay you X. So you get that over 25 years. If you die earlier, well, you lose out. If you live longer, you win. But really, the main issue is you lose access to capital. So if all your money's in the annuity, and you want to go on a holiday, you want to buy a new car, you need a lump sum, it can be difficult. So that's predominantly why we don't do annuities.
Australian market, do you think that's improving? The dollar's at the 76 point, whatever it is now.
Yeah, certainly.
How's that going to affect our exports? Do you think that's going to knock it down a little bit?
I think, well, our exports, predominantly iron ore exports, are more driven by China as opposed to what our economy is doing. And as we saw with the Chinese slowdown, there was a real uptick in iron ore prices last month or the month before, almost out of the ordinary. But that was more of an aberration. The general trend is that China will consume less steel, and more so, they'll be able to recycle steel. A lot of the mining boom was then purchasing our steel to use in their buildings. As their buildings become decrepit and need to be replaced, they don't necessarily need to buy all the steel again to replace a new one because they can recycle a large portion of it. And a lot of investment in China has been to efficiently recycle steel so they effectively don't have to buy as much. But I mean, the outlook for our Australian economy, we like to think it's positive over a longer period of time. Day to day, again, it's anyone's guess. As we said, a good news article or a bad news article can drive the market up or down accordingly.
Yeah, and of course now you've got the talk of the early election and all that. It's going to stop a lot of investment to see which way it goes.
And all of that talk just leads to uncertainty, and uncertainty breeds volatility. So yeah, I wouldn't be surprised to see increased levels of volatility leading up to an election. There is an aspect where a lot of people sit on their hands waiting to see what's going to happen, and then there's also the political and regulatory risk. Superannuation is always on the cards as to whether they're going to change the rules, what are they going to do. It all breeds into volatility. All right. I think that's about it.
Thank you.
Thank you for coming. Much appreciated.